Episode 3: Asset Allocation. Building a portfolio for any market. Disclaimer. This content is for educational purposes only and is not financial advice. Always do your own research or consult a licensed financial advisor before making investment decisions. If there's one thing that separates average investors from those who consistently build wealth, it's this: they don't just pick investments, they design portfolios. Picking stocks without thinking about asset allocation is like building a sports team by only recruiting goal scorers. You might win some games, but you won't have the balance to win championships. 1. Why asset allocation is the real driver of returns. A landmark study by Bernstein, Hood, and Beboer analyzed pension fund performance and found that over 90% of portfolio returns were determined by asset allocation, not individual stock selection or market timing. Vanguard confirmed similar results in their own research, showing that the mix between stocks, bonds, and other assets explains the bulk of long-term investment outcomes. The lesson: what you own matters far less than how much of each category you own. 2. The relationship between risk, return, and volatility. Every asset class comes with its own trade-off. Stocks historically return around 9 to 10% annually over the long term, but with high short-term volatility. Bonds return around 4 to 5% annually, with far less price fluctuation. Cash earns around 2 to 3%, but is safest in terms of market risk, though inflation eats into its value. Historical data. From 1928 to 2022, the S&P 500 averaged about 9.6% per year. The worst one-year drop? 43% in 1931. Long-term government bonds averaged about 5% annually over the same period, with far smaller drawdowns. Understanding these trade-offs is key to building a portfolio you can stick with. 3. The core asset classes. Stocks, equities, ownership in companies. Higher growth potential, higher short-term risk. Bonds, fixed income, loans to governments or corporations. Lower volatility, income generation. Cash and equivalents, treasury bills, money market funds. Liquidity and stability, but low returns. Alternatives: real estate, commodities, private equity, crypto. Often less correlated to traditional markets, but can have unique risks. Action tip: your portfolio should usually have all 4 categories in some proportion, based on your goals and tolerance for swings. 4. Matching allocation to your goals and risk tolerance. Asset allocation is personal. 2 investors could have the same age and income but completely different allocations. One might be more aggressive because they can tolerate risk, the other more conservative because they prefer stability. Example: aggressive growth, 80% stocks, 15% bonds, 5% cash balanced. 60% stocks, 30% bonds, 10% cash. Conservative income, 40% stocks, 50% bonds, 10% cash. Rule of thumb: one classic approach is 110 minus your age equals percentage in stocks. A 40-year-old might start with 70% stocks. But this is just a starting point, your situation matters more. 5. Real-world example portfolios. The 60/40 portfolio. A long-time standard, delivering solid returns with manageable volatility over decades. From 1970 to 2022, a simple 60% S&P 500 40% bonds mix returned around 8.8% annually with far smaller drawdowns than an all-stock portfolio. The all-weather portfolio, Ray Dalio, designed to perform in any economic climate. 30% stocks, 40% long-term bonds, 15% intermediate-term bonds, 7.5% gold, 7.5% commodities. The 3-fund portfolio, widely used by index fund investors. U.S. Stock Market Index Fund, International Stock Market Index Fund, U.S. Bond Market Index Fund. Each of these approaches balances growth and safety in different ways. The right one for you depends on your time horizon and comfort with volatility. 6. Understanding time horizons. Your time horizon should shape your allocation. Under 5 years, prioritize capital preservation, lean toward bonds and cash. 5 to 15 years, balance growth and safety. 15 plus years, you can afford more stock exposure because you have time to recover from downturns. History shows that the longer you stay invested, the lower your chances of losing money. Over any 20-year period since 1928, the S&P 500 has never delivered a negative total return. 7. Diversification, your first line of defense. Diversification is more than owning a lot of stocks. It's about spreading investments across asset classes, sectors, and geographies so no single event can derail your plan. Across asset classes: stocks, bonds, real estate, commodities. Across sectors: technology, healthcare, finance, consumer goods, energy, etc. Across geographies: US, developed, international markets, emerging markets. Data point: from 2000 to 2010, the S&P 500 delivered just 0.95% annually, the lost decade, but a globally diversified portfolio returned closer to 4 to 5% annually because international markets outperformed US stocks during that period. Action tip: aim for assets with low or negative correlation so they don't all move in the same direction at the same time. 8. Understanding correlation and why it matters. Correlation measures how assets move relative to each other. A correlation of +1 means they move in the same direction. 0 means no relationship. 1 means they move opposite. Example: stocks and long-term treasury bonds often have negative correlation during market crashes. When stocks fall, bond prices often rise. By combining assets with low correlation, you reduce portfolio volatility without necessarily sacrificing return. Example: from 1970 to 2022, a 60/40th stock bond portfolio had about 25% less volatility than an all-stock portfolio, yet delivered 90% of the return. 9. Rebalancing. Keeping your risk in check. Over time, certain assets will grow faster than others, skewing your original allocation. Example: you start with 60% stocks and 40% bonds. After a few years of a bull market, you're at 75% stocks and 25% bonds. Now you're taking more risk than intended. Rebalancing means selling some of what's grown too much and buying more of what's lagged to restore your original allocation. Frequency. Once or twice a year works for most investors. Avoid constant tinkering. The goal is discipline, not market timing. Data point: Vanguard research found that rebalancing annually maintained returns while reducing risk compared to never rebalancing. 10. Tax-efficient asset allocation. It's not just what you own, it's where you own it. Tax-advantaged accounts, 401k, IRA, hold high-yield bonds, REITs, and actively managed funds that generate lots of taxable income. Taxable accounts. Hold tax-efficient index funds and ETFs with low turnover. By placing investments strategically, you keep more of your returns after taxes. 11. Behavioral traps in portfolio management. Even with the best allocation, human behavior can sabotage results. Chasing last year's winners. Panicking and selling after a drop. Refusing to rebalance because it means selling winners. Solution: automate as much as possible. Set up automatic contributions, automatic rebalancing, and periodic reviews on a fixed schedule. 12. Step-by-step guide to building your first allocation plan. Step 1. Define your time horizon and financial goals. Step 2. Assess your risk tolerance, both financially and emotionally. Step 3. Choose your target allocation by asset class. Step 4. Select low-cost, diversified investments to fill each category. Step 5. Decide on a rebalancing schedule and method. Step 6. Automate contributions and stick to the plan. Closing takeaway. Asset allocation is the foundation of a resilient investment strategy. It's not about chasing the hottest stock, it's about designing a portfolio that can weather storms, capture growth, and align with your goals. Thanks for watching episode 3 of Capital Outlook 60. Don't forget to like, subscribe, and follow for more investing insights.